Hi everyone, Lee Pacchia here. I'm happy to say I'm joined in studio today by Mitch Eitel. He's a partner at Sullivan Cromwell. Good to see you. Thanks for stopping by.
Oh, it's my pleasure.
So you run something at Sullivan Cromwell called the Financial Institutions Group. Could you tell me what that is and what you do?
Sure. What I do is a longer story. Our official roster is about 33 partners and something over 50 associates and other lawyers, but it's really even more than that. Financial institutions for us includes coverage for banking, insurance, asset management, alternative asset management, regulatory and enforcement work. On the enforcement side, we work together with our litigation group, anti-money laundering, consumer compliance, OFAC sanction compliance. And most of our practices, and I think most law firms organize their practice based on the sort of subject matter of what you do. It's a merger or an acquisition, it's a capital markets transaction. And many years ago, we decided it made sense to group all of our subject matter practices that deal with banks and other financial institutions into one umbrella group, and we call that financial institutions, now financial services. So the lawyers there do kind of everything, if it's for a bank or an insurance company. So we cover all, the full range. So if it's a merger, we'll do it there. If it's a, capital raising transaction, we'll do it. If it's an enforcement matter, we'll do it, as long as it's a bank or insurance company or asset manager.
So how's business?
Business is busy. Given the nature of how we organize ourselves, the practice is countercyclical. So while M&A and capital raising were a little on the slower side than we might otherwise like, enforcement and regulatory issues were way up. Congress helped us out with, at least from this perspective, our clients will have a different perspective on it, but they helped us out with Dodd Frank and the Volcker Rule, which generated quite a bit of counseling work. And so, the things are just starting to chug along, I think, a little bit on the transactional side now, so this cycle is coming back. So we're seeing a rise in M&A work. A lot of that's been private transactions, dispositions, consolidation-related transactions that don't involve public companies, and now we're seeing public companies come back into the game. So, once you had the Susquehanna deal, which is coming close to closing, and a couple of other deals, there have been more on the rise. Capital markets have started to come back to life. We're seeing a number of small IPOs for banks and follow-on capital raises. That business, I think, still still has a ways to go before the markets are really active. Clearly, banks need to raise capital, as do other institutions. But we have a lot of other work, like the preparation of living wills for our clients, enforcement matters, which continue, OFAC and AML-related things continue to be busy. Consumer compliance is really at the leading edge, and we see that going forward being a bigger and bigger thing. And the last thing I'll mention is one of the things that relates to the M&A business is the appearance of shareholder activism in the financial services sector, which is something we saw once in a while in the past, but we're seeing it very much as an important shift in the landscape for financial services companies now, and I think that'll continue to be the case.
I wonder what your clients make of the world today. Is there a sense out there that the crisis is behind them? Or do they look at the legal bills they're getting year over year that are still, they're sizable? I can imagine them turning around and saying, look, it doesn't really feel all that different today. Where are their heads at?
I think it's a really good question because it explores a little bit of the psychology, which is, that's sort of a tougher thing to come to grips with, right? We can see, look, post-financial crisis, there were tons of litigations that were generated by mortgage-backed securities and mortgages generally. Then you had a shift. Now you had LIBOR, you had FX, and a number of other things that rose very quickly. On top of that, you had the shift, as I mentioned, with Dodd Frank and other legislative and regulatory initiatives where the banks felt like there was a true onslaught. The ground was shifting under their feet. There were crises that would come up every day, new crises that needed to be addressed and dealt with. Many of those things remain with us. Mortgage-backed securities litigation has not gone away, although I think there's a perspective among the financial institutions that it will roll off with time. So maybe they're not taking large provisions, but they're still litigating those. So there are certainly large legal bills coming. The other elements of the psychology, though, that affect the financial services industry haven't gone away. It is still a new frontier in enforcement and regulatory environment. The relationship with regulators that financial institutions have today is different. There has been so much attention paid in the press to the manner in which the examination process operates, for example, and what is the Fed doing about this, and what is the OCC doing about that. That element of the business of financial institutions, which is dealing with the regulators and having concern over the potential for enforcement action coming out of so many different things, is not gone. I think that's probably a permanent element of the landscape, while things may temper over time.
I want to talk a little bit about what's going to happen going forward. We were talking with a lot of our sources about what happened with GE. A couple weeks ago, they effectively announced their decision to leave finance entirely. It's been said in and around that conversation that finance is going to become riskier and less profitable than it has been in the recent past going forward. Is that a notion you agree with?
Well, riskier is harder to put your finger on. Less profitable is much easier to put your finger on when you think about all the things that financial institutions face today. I mean, GE is in ways a bell cow, I think, that signals certainly the burden that's presented by the range of changes that have been made in Dodd Frank and subsequent capital, stress testing, liquidity requirements, and just governance requirements. It is certain that all of this has built up to a situation where banks and other lending institutions in particular are under a lot of pressure because the costs of their business have become so high and the costs of lending have become so high that in many cases they've gotten out of it. GE in a very dramatic way is getting out of it, but the banks themselves are certainly pulling back from traditional lending. It's going to go somewhere else, but it may go somewhere else in a way that is both less profitable and higher risk because it's in unregulated institutions.
Yeah. So GE exiting this business in a sense presents an opportunity for expansion among other players in this space. Can you talk to us a little bit about some of the factors that go into making a decision as to maybe expand in 2015?
Well, certainly. If I'm an unregulated institution, so I don't have to worry about increased capital costs and as I mentioned, stress testing, liquidity requirements, all the things that go along with being a bank, I certainly have to be thinking about getting bigger in the lending arena, whether it's commercial lending or consumer lending. One of the things that will weigh on people's minds is, am I going to become the next GE though if I get too big in the space? So what happened with GE is a designation by the FSOC saying GE is a systemically important financial institution. One of the factors there is size. If I get big enough, and if I'm in other complex businesses that may be seen as raising systemic issues, I could find myself in the same position as GE at some point. I have no idea where those lines will be drawn, but I think that's on people's minds and will be.
Mitch, great stuff. Thank you for stopping by and talking to us.
It's my pleasure.
That's Mitch Eitel from Sullivan Cromwell. If you'd like to see more of the stuff they're working on, be sure to go check them out online. You can find them at sulcrom.com. I'm Lee Pacchia. See you next time.